I believe that although there is a breadth of derivative action in our economy, I believe that a significant amount, if not the significant majority of the amount of those transactions falls under the jurisdiction of this committee. And I appreciate your attention to that fact. I also agree with the comments that both the chairman and ranking member have made. Recent events in the credit markets have highlighted the need for greater attention to risk management practices and counterparty risk in particular. And although I agree with the need to focus on where we can standardize and the types of risk reduction and better practices that we need to address, I also want in my remarks to just focus very quickly on one specific part of it, and that is not letting the pendulum swing too far to the other side to where we cause damage to an efficient economy. The creation of clearinghouses and increased information to trade information warehouses are positive steps to strengthen the infrastructure for clearing and settling credit default swaps. While central counterparty clearing and the exchange trading of simple standardized contracts has the potential to reduce risk and increase market efficiency, market participants must be permitted to continue to negotiate customized bilateral contracts in over-the-counter markets. Many businesses use over-the-counter derivatives to minimize the impact of commodity price, interest rate, and exchange rate volatility in order to maintain stability in earnings and predictability in their operations. If Congress overreaches or bans or generates significant uncertainty with regard to the legitimacy of decisions to customize individual OTC derivatives transactions, I believe there could be very significant negative implications on how companies manage risk. In the contemplation of this hearing and this issue, Mr. Chairman, I actually requested that a number of the end users of these types of transactions respond to a question about what increased flexibility or reduction of flexibility would do. And at this time, I'd like to just share 3 or 4 examples of responses that I've received. David Dines, the president of Cargill Risk Management, indicates, while margining and other credit support mechanisms are in place and utilized every day in the OTC markets, there is flexibility in the credit terms, the credit thresholds, and types of collateral that can be applied. This flexibility is a significant benefit for end users of OTC derivatives such as Cargill in managing working capital. Losing this flexibility is particularly concerning because mandatory margining will divert working capital from investments that can grow our business and idle it in margin accounts. While it depends on market conditions, the diversion of working capital from Cargill for margining could be in excess of $1 billion. Multiply this across all companies in the United States, and the ramifications are enormous, especially at a time when credit is critically tight. Kevin Colgan from the corporate treasurer of Caterpillar. Our understanding of currently pending regulation in this area is that it would require a clearing function which would standardize terms like duration and amount. Any standardization of this type would prohibit us from matching exactly the terms and underlying exposure we're attempting to hedge. Thus, in turn, it would expose us to uncovered risk and introduce needless volatility into our financial crisis. I have a number of other examples which I will insert for the record, Mr. Chairman. And if possible, I'd like permission of the committee to insert the letters that I received in response to these inquiries into the record. And I may get another in the next couple of days. The bottom line, Mr. Chairman, is I completely agree with the need to do as much as we can to assure that we have covered the risks in our economy that have been created by the utilization of these types of derivatives, different types of derivatives, credit default swaps, for example. I just believe that we want to pay very careful attention to making sure that we do what's necessary to protect and strengthen our markets, and that we leave flexibility where it's necessary and helpful for the utilization of these credit instruments to advance the interests of our businesses.
Thank you, Senator Crapo. I think you've illustrated the challenges ahead very well in terms of that balance. Senator Bennett, do you have an opening statement?
I don't, Mr. Chairman. Thank you for holding the hearing, and I'm very appreciative that the witness
remarks that there are circumstances in which non-standard products are very legitimate, and that there are legitimate reasons for us to engage in customized transactions. And obviously the question that I'm interested in here today is how do we make sure that we regulate to the extent possible in such a way that makes certain that we don't basically engender greater inefficiencies and risk in our economy as a result of the way we treat these types of customized transactions. As I've read your testimony, Ms. White, for example, indicates that these non-standard products can pose significant risk management challenges because they can be complex, opaque, illiquid, and difficult to value. And in your testimony, Chairman Shapiro, you indicate that one way to deal with these non-standard types of arrangements is to impose appropriate margin and capital requirements on the participants in these customized transactions to reflect the risk that they pose to the system in general. The question I have when we get to that point is, can we evaluate the level of risk that these transactions pose? I think that you would each agree with me that as we have watched derivatives operate in the last few years, that there have been some incredible abuses that have put incredible systemic risk in our economy, but there have also been a phenomenal number of very effective uses of credit default swaps and of other derivatives that have helped to create efficiencies and strength in our economy. And so the question I'm getting at is, can we evaluate these non-standard arrangements in such a way that we can tell whether they are truly generating risk that should then be subjected to greater margin and capital requirements?
I think we can. Can we do it perfectly? Probably not. But I think through imposing risk limits on dealers, stress testing, ensuring that the margin levels are sufficiently conservative and high and stress tested so that we can have some comfort about that. Requiring operational controls, things as simple as separation of duties and trading limitations on individual traders, requiring that they have robust compliance systems, that the firms have credit policies, that they are required to know their counterparty and understand the risks of a bilateral arrangement with that particular counterparty. I think through real vigilance on the part of dealers, which will come mostly with real vigilance on the part of the regulators overseeing the dealer conduct, I think we can certainly do a much better job than has been done historically.
Mr. Gensler?
Well, I think we can. It certainly poses challenges. Much of the marketplace is standardized. There are various estimates, and I haven't seen any very good data, but over half of the market is certainly standardized, and some would say a lot more. And even on the tailored or customized side, sometimes it's just that it's 1 month off. But on the truly exotic, if it's highly customized, I think that beyond that, which what Chair Shapiro talked about, I think it will be appropriate and to have higher capital, higher margin standards for that dealer. You mentioned the letter earlier from Caterpillar. I think they could absolutely customize and make sure that they hedge their risks. But if their risk is a little different than the standard, well, it's probably almost the same capital. But if their risk is really quite different, then it's hard to value that risk. And then the dealer on the other side might have to put up even more capital in that regard. But risk, if I might say, is risk. And if it's really highly standardized, we want to make sure the dealers have enough cushion in tough markets.
So are we saying then that our inability to standardize the risk means that the risk is higher?
Well, it generally in markets does mean that. It's not always the case, but generally if you can't standardize a product or you don't see other people trading in that product, that risk then is a little harder to unwind, it's not a technical term. And so if a commercial enterprise wants to enter into a transaction that's standardized, it probably means there's 10 or 20 or maybe hundreds of other parties that want to either speculate on that risk or hedge that risk. The more difficulty is when there's no other party on the other side. And frankly, that's also the problem in crisis, when there's no other parties to take the other side.
Thank you. Ms. White?
The board believes that there's value in these non-standardized products, but it also recognizes that there are challenges in managing the risk associated with the non-standardized products, both from the standpoint of the firms and from the standpoint of the supervisors. Clearly, improvements need to be made, and there are projects already underway in the supervisory community evaluating, for example, the appropriateness of the capital standards associated with them to make sure that the non-standardized products, the capital charges attached to them, fully reflect the risks of those products.
Thank you.
Thank you, Senator Crapo. Senator Johans?
Well, let me thank the witnesses for being here. Chairman Gensler.